All right, everybody. Hi, I'm Paul Grand here at MedTech Innovator. Welcome to MedTech Innovator Live. This is our series of weekly webinars that we do during MedTech Innovators Accelerator Program, which is basically 4 months. It's an opportunity for the many companies in our cohorts. We have 88 companies this year across our 3 cohorts. It's an opportunity for them to learn from experts from all across the ecosystem. For those of you who don't know MedTech Innovator, we're an accelerator, but we're a downstream accelerator, meaning we're not looking for people with ideas. We're looking for companies that are up and running, that have teams and prototypes, early evidence that shows their technology is going to work. And then we partner them with experts in the industry, with strategics and with others who can help them bring these products to market as quickly and as efficiently as possible, but also with as much value as possible. And so today's webinar is part of that series. We have our companies here on Zoom, and they're going to get a chance to ask questions. They've also supplied us with questions in advance, which is going to guide the discussion. And at the end, we'll have a 30-minute private Q&A just for our cohort companies who are here in the Zoom. For everybody else, if you're here on YouTube watching, you can try and put some questions to the YouTube chat box. We'll do our best and try and answer your questions if we can, if you submit them in the YouTube live box. Otherwise, any questions or any things that look like we need to link them, we'll put them into the YouTube comments at the end. So with that, let's go ahead and talk a little bit about today's discussion. So this is going to be really interesting. So for those of you who don't know, which is definitely be some of you. I myself was an entrepreneur in terms of my background, started 8 different companies. And after that, I became a venture capitalist. I thought I might be in venture capital for a year or two, learn the business and get back into running a company. But 12 years later, I was still a VC. MedTech Innovator is something we started while I was a venture capitalist, and I'd probably still be there if it wasn't for the fact that MedTech Innovator grew so quickly that we had to spin it out. So I know quite a bit about VC, but the reason we've got other people on here is there's a lot of other things to know about venture capital than I could tell you. So we're really excited to have this discussion today with a number of active investors in the medtech and health tech space. So with that, I'm going to go ahead and introduce our panelists for today. So we have 4 panelists. I'm going to bring up the gallery view over here so we can see all of our panelists. I'm going to let them each introduce themselves. We're going to start off with Anne DeGeest, who's the founder of Health Tech Capital. Anne, tell us a little about yourself, your background, your company, and anything else you want to share as a brief introduction.
Thank you, Paul, and thank you for inviting me. I'm Anne DeGeest, and I started and founded Health Tech Capital. My background on the personal side, that little accent you hear is a Belgian-French twist, in case you were wondering. So I started my career a bit like Paul, at first as an executive, and I basically went into the startup world with a company called Nettlecore. And then I coined the word health tech 35 years ago. And I was really an early pioneer of the space, got really very lucky or smart, depending on how you look at it, in having 8 IPOs and several $1 billion exits there. So got really lucky to have so many unicorns. And then I started in 2010, Health Tech Capital, with the idea that we really needed to help companies change healthcare delivery as opposed to traditional med tech. And we are a membership organization that comprises accredited investors. Around 20% of our members are physicians, as well as VCs and corporate VCs, including several big names. Take a look at our website, healthtechcapital.com. We have invested over 50 companies in our portfolio. We are trying to be totally unbiased. So it turns out I calculated after the fact that 26% of our CEOs are female. We love MedTech Innovator. In fact, one of our companies won a few years ago, and several other ones have done very well. So we think it's a fantastic program. So congratulations for being part of the program, and I'm looking forward to enjoy my panelists today.
Excellent. Thank you, Anne. Great having you here, and we're big fans of yours as well. So let's move on then to Jason Halleck, Director of Emerging Technology at Dexcom Ventures.
Hi, I'm Jason Halleck. I have been with Dexcom for a little bit over 11 years now. I grew up along with the company as it was growing into a bunch of different roles. So I started in an R&D function and now have moved on to the venture fund that we've started 18 months ago with $100 million. And we are looking at investing in continuous sensing and kind of continuing growth of Dexcom into other continuous and health sensing space where other diseases and besides diabetes can be managed with more information and more directed care.
Excellent. Thanks, Jason. We're going to dig more into that in a little bit. So then let's go on to our third panelist for today, Tamir Mary from Johnson & Johnson Investments. So JJDC, Director of Venture Investments. Tamir.
Thanks, Paul. So everybody met or seen most of you at the Wilson Sonsini / MedTech Innovator conference in June. I'm Tamir. I'm part of the investment team at JGDC. I'm based in the Bay Area, and I cover all our investments on the West Coast, which is anything west of the Mississippi. I moved here from Israel about 9 months ago, where I led all of our investments in Israel and Europe together with Zev. My background is biomedical engineering and physical chemistry. I've had the pleasure of being a supporter, mentor on the MedTech Innovator team very early on, I think for the past 5 or 6 years. And J&J was actually one of the first supporters of MedTech Innovator, and we continue to do so every year, and we're very happy for that. And I'm, excited to be on the panel with esteemed guests and colleagues, and hope this will be a good one for you.
I expect it's going to be a great one. So let's get into some details. I think, Jason, you already talked a little bit about the kinds of things that, you're investing in over at Dexcom, but Anne, I don't think we got that from you. So is it only health tech? What do you focus on?
Yeah, no, good question there. We do like seed series A. We have done bridges to the B, but our sweet spot is seed series A. We focus on what's called non-heavy FDA products, and that will therefore include all health tech as well as what's called 510K de novo on the med tech side. We don't do drugs, legally or illegally, I should say. I guess this is recorded. I should be careful.
Good. I'm glad to hear you don't do drugs. And thank you for clarifying on stage as well. How about you, Jason, in terms of stage, and areas of focus? Anything else you want to share?
Yeah, so we also don't do drugs. So that's at least we have that in common. And we invest in seed and Series A traditionally. We have kind of infinite flexibility in the fact that we're backed by a parent company that has a balance sheet that they can, move more aggressively. So if we found the right deal, I think we could move in any stages, but that's not really our focus. It is seed and Series A.
Excellent, thank you. And how about you, Tamir?
So I'm part of the MedTech team, which is very fitting to the MedTech Innovator. We obviously have our consumer and farm investors on the other side. Just in essence of time, I'm not going to cover those focus areas. But on the medtech side, it mostly has to correspond with the existing franchises we have. So a lot of it these days is around orthopedics, sort of corresponding with our DePuy colleagues or anything in spine, trauma, robotics, biomaterials, joints, knees, and the such. And from the Ethicon perspective, anything around general surgery, so tools, biosurgery, sutures, energy, robotics as well. As you know, we've acquired 2 big companies in that space in the Bay Area over the last few years. Surgical Vision, which is part of our AMO acquisition in 2016, and then CSS, which covers our Biosense Webster, Cerenovus, Mentor, and other businesses are really around AFib treatment, electrophysiology, and neurovascular interventions.
Excellent. Thank you for a little background on that. So now let me just give a little ground rules for those who are watching. So for those of you who are part of the MedTech Innovator cohort, you're here with us on Zoom. If you have questions for our panelists, you can put them into the Q&A using the Q&A button at the bottom of the screen. I'll be watching that. If it's super important, I'll interrupt our flow of our conversation to get to the question if I think it makes sense during the main flow. Otherwise, I'll save them for the end for the private Q&A. But if it's something that I think is going to add a lot of value, then I'll make sure we do that. And if you have a really important clarification, just put it into the chat. I'll also be watching that. Otherwise, just put the questions in Q&A. Again, for those of you on YouTube, you can use the YouTube chat box, and one of my team members will relay those to me if they see anything. All right. So with that, let's keep going. So we talked a little bit about criteria. I want to know what's interesting and exciting to you in terms of investments. Like what makes for a compelling investment? What are the kind of the key things that people need to have that make something exciting for you? Maybe even sharing something from a deal you've done recently or something that you found particularly compelling to at least provide a little context for people. So Anne, let me start with you on that.
Yeah, no, great question. My view is that too many people are trying to sell technology. We don't invest in technology, we invest in solutions. And what I mean by that is that it's all about the unmet need. Is there a sense of urgency that people agree it's a big unmet need? Is this a big market? Is somebody willing to pay for it? And what will it take for them to convince to change behavior? So for me, I say spend more time describing the problem and the pain point. Then you can tell me what the technology is. Then you can tell me how you think you're going to fix it. So my experience in having built this company before, so I've been in your shoes, the entrepreneur in the room there, is that spend more time in the viewpoint of all the different stakeholders about what is the perception about that unmet need. And if there's a conflict and like a doctor or nurse will block it, then you're in trouble. So spend more time on what is the problem and why you may be the solution.
All right. That's a good point. A lot of people just focus on the technology and they're not really getting to the big picture. What about one more thing on that? And what about team? How important is the team to you?
Well, when in health tech, the market went crazy in the last 2 years, and I think people spend less time checking team. I think now we're back to where we should have been, which is if you have a good horse, you need a jockey. And I think the team is critical. In the seed to early stage, there's always holes in the management team. So what we're also looking is not only the people, usually maybe a physician and maybe an engineer, but also did they surround themselves with the right advisors? So for example, you can basically add people there that have market creations or have built company before. That gives us a sense that they know the weaknesses. We don't expect the whole team to be in place by the time we invest, but we want them to be aware of what they have and what they don't have, and that they complement it. So that's really a big thing. That's a yellow, red flag, or green flag, depending how you look at it.
Excellent. Let me go to you, Tamir, for a second here. So, what again makes for a compelling investment for you? You're at a corporate VC, so it's a little bit different, perhaps. But is it that much different than what Anne's already said? And also tell us about team. Is that important to you?
Yeah, so obviously, second everything that Anne has said, right? It's important for us, really. At the end of the day, all of us, whether it's Anne, myself, yourself, Paul, or Jason, we are all here to serve at the behest of the patients, right? We're here to bring products to market that serve the patients, improve outcomes. That's probably the most important goal of everything that we do. Obviously, team makes quite a big component of that secret sauce. Certainly something we look into as part of the investment. We may not preclude an investment by saying that the team is not strong enough, mainly because we think we can always complement that, whether from value coming from J&J or by simply bringing people into the company. So that's important, but I think there has to be some right component of team at least in existence before we invest. With regards to anything else, as a corporate investor, we're somewhat biased towards something that would be easily onboarded into one of our franchises or platforms, right? So we wouldn't invest in something we don't operate in, for example. So it's really important to make sure it corresponds with an existing franchise, an existing strategy, an existing product line, and provides value to the patients, to the physician, to the system, by adding value to whatever we're doing in that space today. That would probably be a prerequisite.
Okay. And Jason, anything else to add on this topic?
Yeah, so I'm going to speak maybe with a different perspective, just because I am representing a corporate venture capital fund. And so I'll speak out of both ends of my mouth. So to kind of to parallel what Anne was saying, like we invest in companies. We're looking for companies that have a nice commercial story of like how they're going to build their company, build a commercial traction and kind of push the bounds of market by meeting unmet need. But we also invest in technologies that are strategic to Dexcom. So that tends to be much more early stage, really kind of tech heavy focused companies that are out there kind of taking usually early research that's coming out of academia and spinning that out into technology companies to develop a more commercial or reliable platform. And that tends to be more circular around what you can imagine Dexcom is already doing as a parent, which is we're doing continuous glucose sensing for those that don't know, with a wearable device. So things that enable either better glucose sensing or other analytes that could be used for other diseases will go earlier and more technology focused with less focus on commercial. And then to speak to team, sorry if that's, I'll just kind of run them together, Paul. To speak to team, I agree actually with the rest of the panelists. The team is becoming, has always been important, but it may be coming more into focus. And then echoing, I like what Anne said about self-awareness. We don't expect either that the teams to be perfect, out of the box, but the awareness of where the gaps are and how they're going to grow into a larger and more refined versions of themselves is important.
We did a prep call where we talked about various things, and I remember around team, one of the topics we all were talking about is background checking. Do you guys background check the entrepreneurs as a way of vetting if this is not a serial entrepreneur that you know well? What does that look like? Anne, is that something that you do?
No, we don't. What we do is that if we I usually test them the flexible versus fixed mindset. And what I mean by that, in my experience, there's 100% correlation between people with a flexible mindset and success. But there's also, so I typically disagree. I shouldn't say this on the record. I disagree and I see how they take it. If they start arguing with me to say, I don't know what I'm talking about, it doesn't matter what the subject is. It shows an inability of adjusting and correct. And entrepreneurship is the ability of making decisions with 20% of the facts, move the ball, learn more data, and adjust and correct. And if the team is behaving that way and it's acting as a team, then we may want to do a reference, via LinkedIn. So I usually LinkedIn to see if I know somebody who knows them as opposed to their reference. So we may do what's called indirect check as opposed to a full background check. That may be different, I think, for Tamir and Jason.
How about you, Tamir?
Yeah, so we certainly haven't done this as part of an official process, even though everything has guidelines and processes within JJDC and J&J in general. I think over the last few years, pre-pandemic and even through the course of the pandemic, we've had certain situations where we've had, for lack of a better term, some rogue CEO and rogue managements, which really created the sort of need to do some sort of a background check. So it's by no means a reach out to a PI to go and start digging, terrible things from somebody's past. But it really is more around asking for references if it's a first-time CEO or if it's, a company that doesn't have known and trusted VC investors, that we could certainly say, hey, if these guys invested, then we can trust them because we've co-invested with them 10, 15, 20 times in the past. So what I do a lot of the times is certainly make sure that we have some of that validation through existing investors, or either ask the CEO to provide some references, recognizing these may be somewhat biased and very selected individuals. So we may sometimes do similar to what Anne suggested, is go on LinkedIn, see who we're connected with that is a mutual contact, and reach out to somebody who we would trust their candid opinion. And it's certainly something we've been doing more over the past 2 to 3 years rather than in the past.
Got it. Okay. And Jason, anything else to add on that?
Yeah, just cursory as well. So I will say that maybe to add on to what was already said, we do also talk to, if there was any previous investors as well, we try to talk to, if there's the previous round, talk to the leads or some of the people that participated. And just to shout out Paul here. Paul knows almost everybody or can connect you to anybody. So I've used him a few times to back check companies that were interested in it as well. It's important how you hold yourself in events like this and how you're able to navigate, as well as the impressions you leave with people that are well connected. So don't burn any bridges along the way.
Thank you. I appreciate that. And I agree completely. The reference checking is so important in many, many ways for all of us in both directions. And I know that's something, we talk a bit about pet peeves and things that, as investors bother us. And again, from our prep, I remember that was something that came up too, which is people who aren't doing their homework. I'm going to just flip to that for 1 second, Anne, and let you share a bit about that. So, what kind of research should a startup do before they talk to you?
Yeah, I mean, in my mind, we are the first customer you're selling to. I mean, if you think about it, you don't have a product yet to sell there. So you're showing your ability. Can you do your homework on us? Go to at least our website, find out what type of company we've invested in. We are very visible on LinkedIn. We have a lot of information on our website. Do your homework. So if you come to me to say, listen, we want to basically pitch Health Tech Capital because we have invested in ABC. I've talked to the CEO companies and you think we're very, very value added. We have a mentoring program. We're looking for ABCD. We're going to probably let you pitch. You're going to go through the selection process. If on the other hand, and I've had this a couple of times when you only have a 30-minute call and they say, well, what do you do? I said, well, at least do me the favor checking behind a pretty visible. So I think, do your homework, find out what do we do, what our portfolio company, make sure we don't have a competitor, so there's no conflict of interest there that you basically trigger, and then show us respect. I mean, ultimately respect our time by doing the homework on us, and then find out what's the good fit, the same way you would do with a customer.
Wait, so you won't invest in two competing companies? Is that right?
No, that's not true. But we've had cases there where halfway through the person find out we invest and then they hang up on us. And I said, well, that's so unprofessional there.
I see.
Very red flag. No, we have invested because one of the things that's unusual about us is that we have multiple members. So we've had cases like in the femtech spaces where we invest in two companies, both medtech. But they have slightly different strategy there. We have different investors, so not the same person investing both, but we have different members of the group. And then we have a bit of a what's called a wall there, so we make sure that we don't transfer the knowledge between the companies there. But we have invested in companies that are very similar.
And Tamir, same thing for you. Do you guys do you invest in competitors in a space?
Well, I wouldn't say direct competitors. We do invest in a space where there are potentially multiple shots on goal for sure. I'd say certainly more on the farm side than on the med device side for two reasons. It's very difficult to manage, clean teams internally. We're similar to Anne, and even sometimes even more stringently, we try to keep very clean teams internally. And there's a very strict firewall between the companies that we invest in and sit on the boards and the connection to the opco within J&J. So there's always sort of a very, controlled manner of a flow of information that anything coming from the board remains within JJDC, doesn't go outside of JJDC, and vice versa from the opco to JJDC. So doing that to begin with is not an easy task to hold, and a very fine line you have to walk as a J&J employee who also sits on the board of a company and serves at its behest, right? So even more so if you're investing in two companies that may be competing, and normally that would happen a lot, that it's the same individual who sits on that board of both of those competing companies. And even if not, we're part of the same team. So a lot of insights are shared pretty freely within JJDC. So what we will do sometimes, though, as I said, is multiple shots on goal. So we may address the same problem looking at two different angles. So, let's take infection, for example. That may be something we would do like two investments. Robotics, we may do two different investments that are, two different orthopedic robotic companies, but one is looking at spine and one is looking at knee. So they're not directly competing in a sense. That is a rare occasion, though, I'd say.
Yeah. How about you, Jason? Competing companies?
Sort of. I think there's always nuance. We do try to we do firewall ourselves. I think there are cases where we've invested in at least one company where Dexcom itself could be a competitor. So there's that conflict there inherently, but we make sure to firewall ourselves off from that as much as possible. And as well as part of the category that we invest in are people that are using glucose monitoring or CGM, the device that Dexcom makes, in kind of new and novel ways. And so two of the companies that we invested are taking on metabolic health in slightly different ways. So you could argue that they're competitors because they're going after the same type of customer, but they have a bit of different flavor to each one.
Okay, great. So, I asked a little earlier about, what makes something, particularly compelling. Is there an example any of you could share on, maybe an investment you made recently and what was exciting to you about it? Who wants to go? Anyone wants to go first? Just raise your hand. Anyone?
I'm happy to go first, mainly
me.
because it's going to be a shout out to one of the cohort companies. So we recently closed an investment into Moon Surgical. And I don't know if you're in the room, but shout out to you and Jeff and David. And yeah, this one is an exciting one, like any new platform, not just a product. It's cool. Having gone around to the lab several times to play around with the device as an engineer and as a geek. It's always fun to see a product in your hands and not just, anything else that's software, and you may need to wait 5, 6, 7 years to see it actually impact and work around in patients. Very experienced team, very cool product, very huge unmet need and sort of filling a good gap within the market. So super excited about this one and looking forward to see how it turns out.
Yeah, let me jump in. So we've done a deal that's really interesting. It's a company called Aquar, and it was started in France, and then in Europe it's kind of really hard to get to the A and the B rounds in medical devices, and so we brought them into the U.S. In fact, it initially went into one of the JLab in Boston, Tamir, and now they're big enough that they've graduated outside of it. And what was interesting is that we were the health tech a credible investor there, and we put a check, but the company raised $17 million using family office and other things like that. So it was an unusual structured deal where you don't have a VC that has 50% of the round in the traditional way there. What they do is called digital pathology. And when they say you do a biopsy of the lungs there, you can find out real time in a procedure room if you have the right amount of cancer cells, and then go back, because the yield can be as low as 50%. And then it allows you to see things which are live cells. And then you can do a whole bunch of cool things, which I cannot really explain there. And so it was a really unusual deal there, because we're able to put together a syndicate that was totally different than what you traditionally see. And I think there's going to be a lot of those in the future.
Great. All right, so let's move on to another topic then. One of the things that I really wanted to cover was some of the things that are unique to consider with different types of investors. So we've got 2 corporate venture capitalists on here, as well as, and you're with something that's somewhere between an angel group and more of an institution. And I know you've got the institutional background too. So maybe I'll start off with Jason on this one. What's anything unique in particular that someone should think about when they're approaching a corporate VC?
I would say maybe back to just doing your homework and understanding kind of not only the product that the corporate, at least for Dexcom, it's easy. You can go on the website and figure out what we make and what we do and what we have stated in our earnings calls that we're interested in pursuing. So kind of having done that background, I think is important. I think we get a lot of people coming to us that want to do research on venture capital dollars, and that just doesn't make sense, which is kind of interesting. So I think making sure that you're coming with to the right people within the corporation, the right group with the right kind of pitch. So sitting in the venture capital function within Dexcom, making sure that you're giving a pitch that's well suited to the person that you're speaking to at the organization. I think that's maybe probably the most important, actually, is understanding what the angle within the organization is. Just to add in one more example, Tamir, we were chatting before this. One of my colleagues, Parth, who we work closely with in the corporate development group, was going to be on a panel yesterday with Tamir. And the venture fund function and the corporate development function are very intertwined here at Dexcom. We work closely together, but we're different people and we work on a different focus. So understanding who you're talking to and how what you are pitching relates to their function.
Tamir, anything you want to add then on the corporate side?
I mean, yeah. So Paul, this as both JGC and BD support MedTech Innovator, right? So we work very closely with them. They are our partners in the business, and I can even sort of give a bit of a secret sauce of a JGC offsite we had a few weeks ago in New Brunswick, where most of our JGC colleagues, I don't want to say were envious, but were commending us for the very good relationship we have with our BD colleagues within the med tech business. So, any sort of company that comes in, we sort of throw the idea at their wall and make sure they're validated, not just from a strategy perspective, but more like, have you seen something like this? Do you think this merits a deeper dive? Right. So we are very intertwined in a sense, but also somewhat disconnected. So their focus is mainly on M&A and sort of later stage deals and distribution deals. And we are more focused on getting things in front of them, whether it's for an equity investment that we will lead and sort of take the charge and sit on the board, but also with regards to setting the strategy when we do invest into the company and try and dictate when would be the appropriate milestone to take a deeper dive with regards to potential onboarding, be it an acquisition, a license agreement, a distribution agreement, or whatever that is. So we are, very much hand in hand with our corporate development folks as well.
Great. And let me just wind up with you on this last point here, which is anything unique about your particular group, or maybe you can, say more generically of angels, since you've been part of Life Science Angels and other groups as well. Anything on the angel side that you'd say is unique, that's different than traditional VC or corporate VC you want to share?
Yeah, I mean, typically we invest at seed series A, so there's an 80% mortality rate. So when we look at a company there, from our point of view, we don't have a 5-year return like a traditional financial VC is, or a strategic exit like, the corporate VC on the panels are. We're really looking for, do we believe this is a big problem there? Do we have the passions for that problem? Because, are we willing to take a chance, that somebody has a way to fix this problem there? And the next thing we've been looking for, especially with the new financing market in the last few months there, is that what will it take for the next milestones to get the next VCs to come in there? Right now, what we see is the VCs have been hiding and going up to higher level, higher ground, as we call it. So the A is missing in action, and people are finding the Series B and the Series C. And we also see the corporate VCs, coming in earlier. And so one of the nice things about our group is that we have small size medtech VCs as well as corporate VC. We can ask them to say, what will it take? So I could go to Tamir and say, what will it take before J&J is ever interested in looking at this? What are the milestones? What's the type of clinical work that they need to do? What's the validation with the FDA? Or if it's health tech, what's the business model? And so that is becoming more and more important. For us, we don't want to do a bridge to nowhere. We want to make sure that we enable the company to de-risk the company in product or market risk, depending if it's medtech or health tech, so that you can attract Tamir and Jason. So that is going to be really important going on forward.
All right, let's talk more about milestones. You brought up milestones, Anne. So people ask me that all the time, right? What's the milestone that we're going to need to get to the next round? Is it the same for everything? Is there like kind of generically to go from, I mean, I know in the tech industry, they'll say like, oh, you have to have a certain amount of revenue to get your A round done or your B round done. Obviously, we're in a pre-revenue world, usually in med tech, not always, but often in a lot of the companies. So, what are some of the key milestones that drive value in the process? So I'm going to start off with Anne on this, and then we'll jump around.
Yeah, no, that's my favorite question. If you look at traditional medtech, it's high product risk going after an existing market. So there's usually not too many questions on the market side. The market is waiting for better products. So it's all about, do you have a proof of concept? Is the proof of concept credible with how many patients you have had? What is the roadmap to the FDA? Have you had a conversation with the FDA? Are they going to ask for 5,000 patients with 5 years follow-up? That's not a good thing for us. And then is there reimbursement? Reimbursement has increased in the risk factor there. So in the early stage, milestones are tied to the perception of the risk. So in order to get the next sets of investors, which may be traditional VC or corporate VC after an angel there, they're going to say, well, what's my perception of the product risk? And what have you done to decrease that perception of the risk? In health tech, it's flip-flop. It's typically a product that has no IP. It's not that complicated to build. It's all about the market creation. It's all about market risk. So in that case, it's going to be user metrics, which is, do you have anybody using the products? What did it take to acquire them, engage them, retain them? Who is paying? And have they shown that they're willing to continue to pay? And, and so it's really about the business model there. So the milestones are unique to each company. And what you want is a savvy first-time investor to help you figure out your funding roadmap, not to basically get free money every 6 months with a SAFE, which I know is another question coming up, but basically to say, what do you do to decrease the perception of the risk to get a new group of investors to basically take a chance on you?
Yeah. All right. Jason, how about you? Anything you want to share in terms of the kinds of milestones that you look for in a fund what can be achieved in a funding round?
Yeah, so I think all early stage companies have in medtech have kind of different categories of risk, and we don't want to take on all of them. So we do invest in different spots for different types of companies and technologies, but we don't want to take on all the risks. So you have clinical risk, you have technology risk, you have regulatory risk, you have reimbursement risk, kind of commercial marketing risk, and manufacturing scale up risks. And there's probably a few others, and kind of each of those flavors depends on the business and what they're going after. But the more risks you can take off the table and show progress towards, the better I feel about investing in your company. And I think the better suited you are for stepping up into kind of later stages or bigger rounds. So kind of understanding what are the risks of your business, being able to clearly talk to those risks and with your investors, and showing how you burn down risks in all those categories, I think is super critical.
All right. And Tamir, anything else you want to share on that before I move on?
Yeah, so obviously second, both Ann and Jason, a lot of the questions really are about risk mitigation. We recognize that startups, especially early stage ones, have a lot of question marks still open that even Series A or Series B may not be able to provide answers to in the course of using those proceeds. But it is really about minimizing risk and making sure that the company is ready for a fundraise at the end of the proceeds of this round, right? So we're going through that process right now with a pipeline company where we are being very direct and very open about what we would want to see as de-risking milestones. Some are commercial, some are clinical, some are R&D related. We try not to be too defined on these to provide some leeway and some leg room to flex on that if we need to. But it really is about preparing it for the next round for two reasons. One, it really means the success of the company, but even with J&J having deep pockets, we don't want to be left hanging to continue to fund the company on our own. We want this to be syndicated with other partners, right? So the company could stand on its own in the case of J&J doesn't require it. So it's sort of a mutual goal for everybody around the table.
And I'm just kind of curious now, in today's funding environment, are you wanting to put more capital in kind of just generically? Are you thinking, and other investors are doing the same, trying to get companies further along with some of the uncertainties in the financial markets or other things? Are you urging companies to take more capital? I'm just kind of generally interested. Ann, how about you?
Well, different answers. So everybody should go to 12 to 18 months minimum runway, however you get there. And that means an extension of the last round, a bridge that has a cap of the last round, but be creative there because you may not get a new lead that doesn't. The data just came out from Silicon Valley Bank showing that MedTech has already had 33% of the deals were down round. And then the ratios of between rounds went from above 1 to below 1, 0.86 there in the last quarter. The other thing is the amount of money has gone down drastically. I think the report that just came out from Startup Health and Rock Health in the last few days there, show another 30 to 50% drop, depending on the sectors there. So the amount of money is lower. And what you see is that people like us, we're first looking at our portfolio company to say, okay, we really need to make sure they have the runway. So we are basically looking back to say, what can we do to anchor our own company there to give them the 12 to 18 months runway there. We're still looking at new deals, but the way we ask the question is that what will it take for you to answer the question we discussed earlier to get those milestones, accomplished there and give you a shot to get some of these more risk-adverse VCs to come in there at the later stage. So right now, I would expect the amount of money is going to go down for new deals, and the data is showing that from Silicon Valley Bank and Startup Health. And then the existing investors are going to reserve more money for their existing portfolio than they had done before. So yes, the VC may talk to you, but that doesn't mean you may get the money. So just be aware, do your homework.
Yeah, another thing I'm kind of curious about from everybody is what you're looking at when you think about exits. So there was a time when you had to, bring a company to the market, you had to generate a lot of revenue. And then that was used to generate a multiple and to justify the valuation and all those things. And then things changed and the markets got a little more frothy. Are we going back to a time where companies have to bring things to the market and build them up? Where do you see things going? I'll start with Tamir on this one.
Yeah, so markets are ebb and flow situations, right? We've been there before fairly recently, right? Hopefully this one is a less turbulent market. I think a lot of it accounts to COVID, not to blame COVID for anything, but we had this sort of near bubble situation up until a few months ago where some of the folks on the call here would say, I have an AI algorithm and you'll get $1 million, no questions asked, right? No diligence whatsoever, because there was so much money slushing around the market. And I think what we're experiencing today is somewhat of a correction for that. And I'm somewhat hearing a lot of that from my friends in Israel, that a lot of, digital health companies are going under, where, initially having seen those, I'd say that there was hardly any differentiation between that company and 3 others that I've seen in that space. So in a sense, that really is a correction. Following Ann's point, right, we've always told companies before, a pandemic and before a crisis, they should always plan for bad days, right? If you were planning to raise 4, probably if you can raise 5, that's better. Just because, always bring in buffers, even if it means like another 1 or 2% dilution on the cap table, simply because who knows what's going to happen in 12 months, right? The markets are so volatile and so quick to judge and move these days that you can't necessarily plan enough. So I think that's part of it. I'd say otherwise, these things are very personal per company, right? Each company is a different story. Some will continue on chugging, maybe talking about being a bit more conservative on using the funds and maybe raising another extension instead of a Series CB, whatever the next round is. And some will struggle because, maybe management is not experienced enough to weather through the storm. So it really is a matter of people and situations and indications. I've seen maybe over the last 4 months, all of it, right? I've seen companies that are chugging ahead as usual, and those are entirely stressed and just wondering where the next dollars are going to come from. So it really depends on, luck and timing, like a lot of things in life, I'd say.
I agree with that. We're seeing things all over the place in our portfolio. Some people, going back and oversubscribing rounds, people doing bridges and extensions and all sorts of things. But I think everyone's probably, as you said, kind of keenly aware that we got to do things to weather the storm here. So whatever that might be, but it doesn't mean you have to slow down. It just might mean, you change some of your strategy. In some cases, people need to put their foot on the gas too. But let's get back to talking a little bit about just some more practical things. So, I know this, Anne, you mentioned this already before, safe notes as something that, is a little bit controversial or maybe unique to certain areas. So let's just talk about safes. So will all of you invest in safes? And if not, why not? Jason, I haven't asked you something a little bit. Let me start with you.
Sure. So we will. But it's not our preference. Speaking maybe to kind of back to what was already been said, having a strong syndicate, and we don't want to be alone in supporting a company, especially as a major investor in those companies. And so not taking the time to kind of we generally don't lead. So not having a strong lead that can set valuation and be part of that syndicate for growth is not our preference. But again, being strategic and depending on what we're looking for in a company, if it is a strong technology play, we'll go there.
Okay. And I know you've had a lot of thoughts on safes, so try and keep it relatively brief, but I want to hear.
I will try. We were forced to get into safe. We don't want to get into safe. I think there's an interesting report that shows that if you look at the angel there, California had 9% of their deals last year that were safe. But I'm also part of the Angel Capital Association operators, which is all the people running large angel group of the country there. And we basically all have agreed that from now on, we are going to say no, no, no to safe, because it doesn't make sense for a long list of reasons, which I know we don't have a lot of time. But right now, SAFE was designed for the first 100K where you don't have a corporation, because you cannot get a note if the corporation doesn't exist. So that makes a ton of sense from the Y Combinator. But then it became crazy when the market bubbled. In my mind, there was a bubble last year. And people were doing SAFE after Series A and Series B. They were doing 6 million SAFE one after another. And the mentality was that you were being driven by dilution. And so therefore, SAFE was a way to basically get free money every 6 months. You just print the money and you go on without adult supervision. And so that's very dangerous there. So I think a lot of these people are going to get a very difficult reckoning when they're trying to convert this into preferred. And I won't go into all the reason why. Maybe we can do it in the Q&A afterwards. But SAFE was totally misused in the last year, and I think that's over.
Yeah. And Tamir, how about you on SAFEs?
Yeah. So historically, if I think we've maybe done one or two, and as a corporate investor, and we have a huge portfolio at any given moment. If you take a SAFE versus a convertible note, as an investor, you'd always prefer to have a convertible note. It's also a simple document, maybe a bit longer, but it does provide you with some of the protection that SAFE certainly doesn't. So it's as Anne said, completely understood when it's either a newly formed company or not a company yet, but when it's already a corporation, whether it's a Delaware or Israeli or whatever it is, probably doesn't make sense for like major investors to come in the SAFE at this point.
All right. Let's go on to another.
I'll add real quick.
Oh yeah, Jason, yeah, go ahead.
I was going to say, the in the froth that we're seeing ending, growth was number one, and everyone was looking for growing as quickly and as possible. And that, to Anne's point of being misused with safes, I echo that. And now having to show value, I think it's changing the funding ecosystem. Is kind of recognizing the errors in its ways as well. And making sure that these companies are able to show the value to justify their valuations, which you have to have a valuation to justify one.
Right. Yeah. Yeah. Actually, and let me go back to Tamir for a second here. So Tamir, Jason has said a couple of times that they don't lead over at Dexcom. Does JJDC lead deals?
Yep, we're not shy of leading, co-leading, just joining. It really depends on how much effort we want to put into the diligence process. On the med device side, I think we've led about somewhere between 30 to 40% of our deals, based on the recent analysis that we've done internally. But it really depends for us on how much we want to lead into the company and potentially even ask for rights. So the later it is, the more likely are to take rights.
Yeah.
But I will say that, even on the deals that I have on the table right now, so, one, we are leading, one, we're co-leading, and one, we're just joining. So, we're very flexible on that front. It really depends on what the company wants and the syndicate wants.
Okay. And you lead too, right?
Yeah. And we're very flexible, like Tamir is saying there. We have done co-lead with our angel group there. So we did a big co-lead on S2 Genomics, which is a biotool company. I think I've applied to you. And so, and what's nice about the co-lead is that you can spread the word, because, you want to do more due diligence. We do a lot of customer reference check, which is nice. I mean, you're in health tech in particular there, we've been able to talk to the primary investigator. It's always enlightening what you hear from the person using the product versus the company can be very different. So we do a lot of those things there, and that gives us the credibility to lead afterwards.
Okay. I want to talk about pitch decks a little bit, changing subjects. So what goes into a pitch deck, especially, that first deck, the one that gets sent to, and does that even what you want to get on an initial, I'm reaching out to you for the first time. Hopefully it's a warm introduction, right? Someone said, hey, you should get to know Anne over at Health Tech Capital, Paul, if I'm raising capital for a company. Do I send you a pitch deck? Do you want to get an executive summary? What do you want to get? You want to get a video? What's your preference? And what do you want to see in that initial pitch deck? How much detail needs to be in there. So Anne, let me start with you on that.
Yeah. Doug Sen had an interesting statistic saying that the average VC spent 3 minutes looking at the deck. So that 3 minutes, 3.45 seconds or something like that. And the most important thing is to have a summary slide you start with. Define what we call the sandbox, which is what's the problem you're fixing? What is your product status? Why do you think it's going to work? What you ask whether you're looking for money or not, and start with that. If we get excited, then we'll spend attention reading the other deck. And the average was 18 slides. My advice is 15 slides. In our case, we have a submission process. We just went live on a new platform yesterday there, which allowed the company to upload slides and video and answer the question, what's your unmet need? What's your competition? So we're much more structured in our process there.
All right. How about you, Jason? What do you like to get as a first introduction to a company?
I prefer things to be as self-service as possible in general. So the kind of the more to Anne's point that I can read it quickly and get through a deck, and I understand what the company does and what they want in kind of in a short order is very important. But also, if I have questions, I'm either linked out to or kind of alluded to where I should dive in on things like technology or how they're doing things. I think being clear and unambiguous of what you're doing it and kind of how you're doing it. You don't have to give the kind of details of your, your secret sauce, but at least understanding, how you're approaching a problem and what you're trying to do. And then kind of how you plan on building kind of the full scope of the company. So like what else is, speaking of like the commercial side of like how you're going to grow, what's your strategy of like how you're going to enter the market, who your customer is going to be, kind of answering all the fundamental questions in a pitch deck is important.
Yeah, and Paul, if I can build up on what Jason just said, know your audience. So if you send it to the three of us, we know healthcare. Don't spend 15 slides telling us how screwed up healthcare is, because we probably won't look at your 16 slides and know what the hell you're doing. So if you're selling to technologies, tourist investors, as I call it, fine, go for it. But talk to us. It says, tell us what's the problem is. We know healthcare is screwed up. Tell us which part you're fixing.
Right. Right. Not that healthcare is X trillion of GDP and all that kind of stuff, right? Like we don't need to know that. Okay. Again, and this is if you're a specialized, life science investor. And Tamir, anything you want to add on the pitch deck?
Yeah. So certainly second Anne's point about don't tell us about the market. We know the market well enough, especially the corporate players who, run some of those syndicated reports on a daily basis. I would add, and Jason, you are probably sharing the same sentiment. Certainly send something non-confidential at the beginning. Anything that's more confidential, we need a CDA for. It's not that we mind signing a CDA. It's just a matter of, let's not just start immediately with a CDA. And maybe a tip to some of the potential entrepreneurs on the line: don't send a CDA and expectation that a big corporate or investor is going to sign that to get exposure to materials. If you don't feel comfortable enough sharing it, that's fine. Share it when you're comfortable. We're not going to sign a CDA before an initial conversation.
Yeah, that's a very good point, Tamir, because I think no VC will sign an NDA in the first or second meeting.
Yep.
They may, if you do IP due diligence in medtech, because there's some sensitivity there. In health tech, we don't sign it.
Yep. Let me get to a couple other practical things, because incredibly, we only have 5 minutes left of the public broadcast. So from a general perspective, often startups are too early, to make an investment. What advice do you give them in terms of staying in touch with you? How early do you want to talk to people? So in other words, like even if it's too early to make an investment, do you like to get to know people early? Do you suggest they still reach out to you, even if they don't have any evidence yet that what they're doing is going to work? But at what stage is it too early to talk to you? And when do you suggest people reach out to you? I'll start, because often I hear people say to me, "Oh, it's too early to call Dexcom." When is it too early to call Dexcom, Jason, if ever?
I would say it's almost never too early to call Dexcom. What we're interested in may not be obvious. So if I'm not going to talk to a company that's super early if it's not something I'm already interested in, but you don't know what I'm thinking about. So if you think it could be uniquely interesting for Dexcom, feel free to send me your early stage pitch deck, and I might answer with it's not early or you're too early for us. But I would say the initial reach out, it's never too early because you never know. But the odds of hitting are probably low. and just expect that you're going to get said no to a lot. That's just part. I'm sure that others will echo on the panel. That they say a lot of no, but doesn't mean it's not malicious. It's just kind of the nature of the game.
Right. And sometimes it's timing too. So it's just no for now, right? So
No for now.
yeah. How about you, Tamir?
Well, I mean, we are obviously somewhat biased to get more de-risked and later stage stuff. We've not been shy about doing company creation in some cases, and go very early. My philosophy, personally, not a J&J philosophy, so this is a Tamir thing, not a J&J thing. I'd rather know about something too early where, it may take 1 or 2 years for us to actually be interested, rather than know about it when it's too late and it's at the hand of the competitors. So certainly reach out. Ideally, I'd say not when it's a pen and paper type of situation, but when you have some sort of a in vivo proof of concept, working prototype type thing that you may need some help or guidance to bring you to the right pathway. It may be too early for us to invest or engage more than an intro call, but keeping that relationship warm certainly helps. I can certainly speak of stories that we've communicated with a startup for 3 years and at the 4th year ended up investing. And some conversations still ongoing with other startups that we've met in 2016, 17 that are PMA, and we're just waiting for the right time. So certainly keep us appraised of what's going on. And if the time comes and it's the right time, we'll invest.
Yeah, I would like to redefine your question, Paul, because in my mind, it's not getting the money. The entrepreneur needs to get the feedback. So when you talk to all those players there, even if they say no or not, ask for the reason. Ask for what's the feedback. It may be the presentation. We give feedback after people pitch to us. And I says, this is what we heard. And I say, well, that's not what we do. Half the time people don't communicate their story correctly there. That's an easy fix. If on the other hand, we perceive there's a huge regulatory risk, or the business model doesn't make any sense, or the assumption are not right, these are very valuable input. And we've had several cases there where initially the company was really early. We give them a lot of feedback that says we don't believe the business models. And then they start learning from other people and they came back with a much better business model and we invested. So at times the objective when you go early is really trying to get the feedback about why people say no. And you may not get it. A lot of VCs disappear and play golf in Hawaii. But some will.
Yeah, no, I agree completely. Ask for feedback because not everybody will give you the feedback, but I definitely would ask for it. It's one of the things that we love about our process at MedTech Innovator, give people lots of feedback. So couple closing questions here for the YouTube audience, and then we're going to stick around for all those other questions we didn't get to for our cohort. Last question here. So in terms of reaching out to you, what's the best way for people to connect with you, since you're all interested in talking to people early. So let's start with you, Jason. How do people find you?
Either connecting through, if you're connected through MedTech Innovator and Paul, that's probably the best way. I'm not going to give out my email today, but just through different programs or incubators, or reaching out even to the generic corporate development email address that's on the Dexcom website, it gets to me. So there are ways to find me. Great.
Anne?
Yeah, we have members across the world, so we have this platform. So if you go to the Health Tech Capital website there, we have a lot of information there. There's one called Submit Your Plan. Click on that. That gets you into a platform so we can basically communicate. We have over 100 members there, so we need to coordinate that way. That's the most effective way to basically work with us.
All right. And Tamir?
Yeah, so folks know how to get to me: email, LinkedIn. All of our strategic focus areas are listed on the J&J Innovation website, whether it's for an early collaboration and investment or even from a JLabs perspective. So it's all public, it's all known, may not be in great detail, but gives you an understanding, high level of what we're interested in. I'm available, so reach out.
All right. And then last question for all of you before we close out the live stream here is, the world, as we said, things have been changing over the last couple of years, COVID, war, you name it, there's all sorts of stuff going on out there, financial crisis, perhaps, or at least there's a number of things that are changing. You're all still actively investing. Is that the case? Anything, is everyone still open for business? Tamir?
Yep, business as usual, and I would even argue even more busy than usual. So
glad to hear that. Anne?
Yes, and historically, angels have been very strong during this turbulence market, and we see the same thing happening. The angels still very active, and we're syndicating.
And Jason?
Absolutely. Yeah, still in here, still investing.
Great. That's really great to hear. So, for those of you here on YouTube, that's all we've got for you in our first hour. Thanks for joining us. MedTech Innovator continues to have our weekly webinar series where you can hear about all sorts of topics, everything from investment, like we've been talking about today, to product development, to reimbursement and payment, to some of the things that are happening, changes in European regulatory approvals and other things, all sorts of stuff to talk about in the coming weeks. So we suggest you go to our website at medtechinnovator.org/live. And there you'll find the schedule for all the upcoming webinars. And we have them every Thursday at the same time. So please look out for that. You can even subscribe to a newsletter that will send you an alert in advance and tell you when the next webinars are coming up and what the topics are. So thanks for joining us today if you're on YouTube. And we hope to see you at another one of our upcoming